Hi everyone, hope you're all doing well, and today we're doing the free UK stocks to buy July 2021 edition, and this is the most popular video series that I run on the channel where I talk about the free stocks that I potentially could buy in the month of July. So as always, if you could smash the like button, that'd be absolutely amazing. If you're new, make sure you subscribe, and if you do want to know if I do go buy any of these stocks, make sure you join the Patreon. Link is in the description. There's a Discord on there with 600 members and also 2 exclusive videos a week, and if you do want to buy any of these stocks, there's some links to a free trade account and a Giro account in the description. You open an account up through that free trade link, you also get a free share as well. But let's get stuck into the free UK stocks to buy July 2021 edition. Now, in general, the UK stock market is starting to hit a bit of a speed bump at the moment. I think that what has happened recently is we've seen an increase in cases, and that's kind of spooked everyone and spooked the market. And people are already starting to think about, well, what happens when we get to December time, winter time? A case is going to carry on going up. I think there's also every so often, I mean, I don't know how many we could actually have because it seems like there's one every week, but a new variant, we think we've had enough of the variants, and then there's another one coming up, and I think that's just kind of spooky people of like, okay, what happens if we have a variant that the vaccine can't handle, and what happens towards winter time? Are we going to have a spike in cases, and that will lead to lockdowns, and the stocks that are more vulnerable to them lockdowns are definitely starting to feel it, and because of that uncertainty, the stocks don't like uncertainty, investors don't like that, and we've seen a few share prices start to wobble a little bit, and some little buying opportunities that are starting to happen. And I think if this is carried on in the press, we should see a couple of share prices still carry on downtrending a little bit. So today I'm going to talk about the stocks that I'm looking to take advantage of right now. So before I get onto the actual list, there's 3 honourable mention. Number 1 was Taylor Wimpey. I was thinking about putting this in the list. House builder, won't bring much share price appreciation in, but is a house builder that will pay you a nice dividend, have a little bit of share price increase. And I think these guys might get affected a little bit with materials going up, but still the housing market is absolutely strong. And yeah, I was up a lot on this one, and now I'm only up like 20-30% on this one. So one that I did consider. Number 2 was Jet2. Jet2 is obviously in the travel space, and the travel space is like the worst place to be in when you got a global pandemic like this. And I think that's why it's just so volatile at the moment, is that people don't know, are holidays going to happen? Are they not going to happen? What's the restrictions like? And yeah, I think that's just the massive uncertainty there. But when everything does go back to normal, Jet2 will be a really good player in this sort of industry. So on the dip it's currently on, I did consider putting that one onto the list. And number 3 is Hotel Chocolate, which I've covered on the channel many times before. So those are 3 that were very close to making this list, so I thought I'd give them a little shout out. But what we'll do now is we'll get stuck onto these 3 stocks that I am considering buying. The number 1 is Hollywood Bowl. So these guys are getting a little bit of a dip at the moment, pretty much because of the reasons I said earlier. I think these guys are fearing a little bit of a lockdown, but Hollywood Bowl realistically have never actually put some decent financials out since the whole CV situation. I think these guys were very late to open up around August time, and they literally had about a month and a half, and then bang, we was hit by another lockdown and these guys were forced to shut. And they've very much been only open up for a couple of months now, and we still haven't seen anything financially really much from Hollywood Bowl for the last kind of year and a half. So we've got no financials, and I think when the financials do come out for Hollywood Bowl, people realise, oh, this is such a good company. Hollywood Bowl, the kind of only month and a half period they were open last time before we had the other lockdown that came in, Hollywood Bowl actually straight away opened up, got to profitability, and then was forced to shut again. So I thought that was very impressive from Hollywood Bowl to put in really good revenue. They were pretty much doing what revenue they could previously, and also then to have profitability, to be able to make profit. And some of these centres, some of them were having limited capacity in, some of them were having like the arcades closed, social distancing at the bars they have, some were having gaps between the bowling lanes. And you think now, well, if they have every bowling lane open, if they have the bar open, the arcade back open, Hollywood Bowl are going to do some really good financial numbers next year. And I think that people are just going to be so keen to get out, and this is what I like about Hollywood Bowl. They're in great locations, they tie it in with like cinemas, restaurants, so you go to Hollywood Bowl for maybe the arcade, the bowling, and then maybe you go to a restaurant that's in the same leisure park, or go to watch a movie at the cinema. And these guys tie into great locations for a good day out, and I think people, especially at the moment over the last 12 months, are going out a bit more, especially if they can't go abroad and summertime. And I think these guys are going to benefit from it. And what we've seen, what they can do previously, is get straight back to profitability, which is really good. As well as that, they're increasing the amount of centres they have, so they're having more and more centres. More and more centres will lead to more and more revenue. And this company historically puts in great revenue growth, it puts in great profit growth. And this company isn't too badly valued. If you go off the last kind of full year we had of actual revenue and profit. These guys, if they could do the same profit, would be trading around about a 14p ratio. And for having a company like this that grows at this sort of revenue, a diverse portfolio, increasing the amount of centers, increasing revenue for 14p ratio, in my opinion, is pretty good. And what they also have is a balance sheet that's pretty strong, even after the CV situation as well. So they might pay down a little bit of debt, but at some point as well, I could see them coming back to paying a bit of a dividend on this one as well. And I think just in general, the more centers they have, the more revenue will go up. They'll get back to profit. Profit can pay debt down or help with expansion, and also go back to dividend as well. So for me, Hold Ball is actually it's my third biggest holding, and it's probably my favorite stock. If I could, I would have this one as my number one position, but it just hasn't worked out because of the timings and everything. But Hold Ball is a massive favorite of mine, and if I could, number one position right here for me. And all I can see over the next 2 to 5 years is this management team opening more and more centres, more revenue, the profit there. I think Hold Ball has a very good future ahead of it. Now, the only problem I do have with Hold Ball is that I'm currently up 50% on my position, so I will be averaging up a huge amount. But when I consider what this could do in the next 2 to 5 years, maybe I could buy some while it's on this little bit of a dip here. So number one is Hold Ball. Number two is Card Factory. So this was a company I was actually up over 100%, and now I'm currently up 30%. So this has had a massive drop, and this had a massive drop off kind of going into earnings, after earnings. A few things kind of I think was the reason why the share price went down. I think first of all, we had the fear of, okay, if there's another lockdown, these guys don't have an amazing balance sheet. So if they were having to force to shut again, Card Factory is not going to look good for them. So going in with a bad balance sheet was probably the spook of having another lockdown or cases rising will definitely affect this one a lot more than other companies. As well as that, they had to increase their balance sheet, increase the cash flow they have because of the debt side of it. And what kind of happened, what came out in earnings is that there's a early payment they have to make, and to do that early payment, they're probably going to have to get capital from somewhere. Where they get that from, we'll see. What's been said quite often is that there's going to be a share offering, and that might be the way they raise capital. But overall, when I look at Card Factory, this company is massively sold off at the moment. This company has been awful from like 2015, badly managed, all the way to 2019, 2020 before the CV, and then CV took it down even lower than where it is right now. In my opinion, Card Factory is probably over between a £1 and a £2 company in my opinion. And I think when we get a full year sales, it should look a lot better, and we go back to this company was doing decent revenue growth and decent profit growth before the CV situation. And if these guys could get back to where they were pre-CV, this is a profitable company and it has revenue growth. Sure, the profit needs to start increasing instead of decreasing, but right now, if they put in 2019's profit and revenue, this company, Card Factory, is going to be trading at a 4p ratio. A 4p ratio, yeah, so cheap. That it's never going to be like a crazy p ratio, but a 4p ratio. I mean, I've never seen a company trade at a 4p ratio that has profit, revenue, and revenue growth as well. So in my opinion, it's definitely cheap on the valuation side of it if it can go to back doing them numbers. Now, recently these guys here came out on their recent earnings and said that they are, I think, 2% down on 2019's numbers. And they said that one thing that did kind of change that is that where they opened up, I think they lost a lot of like their Easter trade, and I think they kind of lost, I think it was the Valentine's Day, I think they lost in trading because they were still shut then. And if they kind of had that then, them two major events, that's where a lot of the revenue comes from, as well as Christmas. So I think if these guys get Christmas sales behind them, that'll be very good for them, and we should see it. That's where, in my opinion, I should see the bounce back in the share price. And that's what I'm kind of waiting out for. So to say they're only down by that much is pretty good. I think what they're kind of doing now is developing a lot more deals with supermarkets to sell the cards. Obviously, they've got the Reject store in Australia that's bringing in a lot more sales as well now. And I think the management team are also looking at other ways to keep developing the website. And also, I think the one big thing now is to go from where they are now and also challenge Moonpig. Because obviously when you compare something like a Card Factory to a Moonpig, there's a massive disconnect there, and kind of the share price, even though Card Factory isn't a terrible company, the valuation's miles and miles apart from each other. So I think Card Factory in general, historically, good revenue growth. Profit could be a little bit better, but it is a profitable company. Balance sheet is the only concern on this one, and this is why I never want to make this a big position, because it has a weak balance sheet, and this is kind of like a turnaround play, which I think they will make it through on the other side. They used to pay a dividend. I don't think they'll ever pay a dividend until they kind of strengthen this balance sheet out, and in fact, in the terms of the contract of the new loan they have, they won't be able to pay a dividend back anyway. So yeah, overall, bit of a recovery play, and I think if they can do 2019's number, this should see a bounce back and a very fast reversal on the share price. So yeah, it's one that I'm considering buying a few more shares on. And number 3 is Best of the Best. So I've covered this quite a few times on the channel recently, but these guys are a company that brings out online competitions where you do spot the ball prizes, and when you do spot the ball prizes, if you win either a luxury car, or they have another midweek competition where it could be a luxury good like a watch or something. So these guys have gone from being based in airports for these competitions to online only. By doing that, the company has grown huge amounts. The revenue has exploded on the company. The profit has exploded on the company. Because of that, the balance sheet is now even stronger than what it was before. There's a lot of cash on the balance sheet because they make a lot of profit from what they do in their sales. And as well as that, what they've gone to do now is they've actually extended their dividend and start paying special dividend. My kind of theory on this one is that they're going to grow decent revenue rate, and also you're also going to pick a bit of a dividend on this one as well. And the big thing that's changed on Best of the Best recently is that the share price has massively sold off. The share price has kind of halved. It's now trading around about a P ratio of 15, and it was probably due a pullback just because it had been on such a good run. But now it's down at a P ratio of 15. I'm considering buying more than what I already have. I already have a lot of shares, but at 15 P ratio for this company does seem really cheap. And one of the things I'm just being very careful of is that because it's been on such a good run, it could go down a little bit lower. But really, when I'm buying a company like this at a 15p ratio, I'm quite confident going into it. One of the reasons for this big massive drop on Best of the Best is that management came out and said, okay, you know, the revenue is starting to slow down a little bit, customer engagement is slowing down, but when you're comparing that to a year of CV, when everyone's been at home, when they've pretty much had, you know, no expenses and looking to spend the money on things, this CV year that we've just had, the numbers are going to be very hard to beat, and it will there'll be a bit of a balancing out, and the share price as well will balance out a little bit because of this jump. And I think that the next kind of 6-12 months might be a little bit choppy for it, but when we kind of balance out and then we see the proper growth from their marketing, because their marketing is so good on this company, and the revenue and profit starts coming back in again, I think that's where we'll see the share price start moving in the right direction. So Best of the Best, I'm not going to spend too long on it because I have covered it quite a fair bit on the channel already, so you can go check them videos out. But I will consider buying a few more shares in this one as the month goes on into July. So I hope you enjoyed the video on 3 UK stocks to buy. Let me know what stocks you're looking at buying and the opportunities you're looking at. Let me know if there's any of these that you're looking to buy as well. As always, smash the like button if you're new, subscribe, and I'll see you in the next video.